How much can Equinor exploit Europe's energy crisis? Welcome to the Valuation Master Class case study, where you'll learn about interesting stocks and how to value them. What's interesting about Equinor is that it saw a 50% surge in its share price year to date. This is Andrew Stotz of the Valuation Master Class. Let's get started. But before we do, this information is for learning purposes only. It's not recommendation or investment advice. So let's look at Equinor. It's in the energy sector in Norway. It's a state-owned multinational petroleum company ranked among the 15 largest energy companies worldwide. It's a big energy company. So the question is, how much can Equinor exploit Europe's energy crisis? There's three things to know about this company. Soaring energy prices in Europe have led to revenue explosion. Second is that the green shift to stay competitive requires CAPEX ramp up. And third, strong years ahead lead to attractive dividend yields. Let's review some key statistics. There's 30 analysts covering this company, and their current target price is about $27, which is about a 4% downside or a hold recommendation on average. The price to book value of this company is about 2.7 times, and dividend yield is about 1.5 times. My value estimate is about $25, which is about 11% downside. Hence, it would not be a hold, it would be more like a sell. But let's say it's a borderline sell or hold. Let's consider the sales breakdown of this company. Natural gas and crude oil trading accounts for 71% of the overall business. 29% of the revenue comes from exploration and production. And 80% of the revenue is coming from Norway, another 14% from the US, Denmark 5%, and then the rest others. And those others I suspect is going to grow in Europe in particular. Now the share price and the volume has remained bullish for a while. In fact, over the past year, the stock price saw a strong rally, up 50% year to date. The 50-day moving average line stayed above the 200-day moving average line throughout the whole period. Therefore, the price signals remain pretty bullish. The volume RSI has stayed slightly above the 50% line, which is a positive sign as well. Let's get into the story. The first part of the story is soaring energy prices in Europe lead to a revenue explosion. Now, in the chart that I show on this particular page, on the chart is two graphs. One is natural gas prices in the EU, and the next one is oil prices in the EU. And what we can see is that natural gas prices bottomed out in 2020 at the bottom of the crisis. And what we can see is that they have gone from about from natural gas price, about $5 per millions of, what is it called? I forgot the term for it, but for the ton, for the usage, for the volume, and it's gone from about 5 up to about almost 80. And as far as oil is concerned, basically it's gone from US dollars per barrel of about $25 at the bottom of the crisis in 2020 up to about 80. So a huge increase. In fact, the economic recovery has created strong demand for energy while supply experiences bottlenecks. Gas skyrocketed by almost 500% year on year. And oil prices risen by more than 85% year on year also. On top of that, maintenance issues in major gas plants in Norway and the unwillingness of Russia to increase supply and the negotiations that are happening with Germany basically has worsened the situation. So what's actually going on in Europe? Well, let's take a moment and look at that. The EU ambitiously cut off traditional fuels without enough alternatives. Renewable energy investments are increasing, but they're too slow to compensate for the supply gap in the near term. Therefore, you could say that the current energy crisis is self-inflicted in Europe. The EU must now import oil and gas from other countries, increasing its dependency. Let's look at Europe's unrealistic pace of green transition causing the slowdown. The chart that I show here is the amount of oil, natural gas, renewables, coal, and nuclear, and how much they're producing as far as energy is concerned. The key thing is natural gas and coal production are down by 53 and 32% respectively in the past 10 years. Most European countries have already closed their coal plants and have started to phase out fossil fuels. But hold on, what we can see is that renewables have grown by 34% and are now the #1 energy source in the EU. Great job that we've seen that growth in the renewables. However, the production level is still far from enough to match demand. Let's just look at that demand versus consumption. What we can see is that the gap between production and consumption is massive. And in fact, consumption has been rising over time, and as it rises, actually the production has been falling in Europe. The only thing that's been keeping it rising, keeping it from falling even more, is the renewables production. Now, lower production while demand for energy has surged is increasing this gap over time. Hence, the EU is now heavily dependent on imports. The structural energy problem is unlikely to be resolved soon. Hence, I expect Equinor to benefit from much longer from the higher prices. It kind of raises a point, which is we all want a clean environment and all that, but the transition to that may take much longer than what many people think. And therefore, if people claim that we can get rid of fossil fuels, we may want to think twice. Next point, the next story is the green shift to stay competitive requires CAPEX ramp up. So, first of all, Equinor started to diversify its portfolio away from oil and gas. Increasing pressure in Europe to shift green faster requires energy companies to adapt immediately. But being state-owned, it should help for a smooth transition. Now, as of 2021, Equinor has a renewable energy capacity of 1.6 megawatts, but the chart that I'm showing here is that as of 2021, that 1.6 is really composed of plants that are under capacity or under construction. In fact, the amount of installed capacity is very low, maybe about 0.6 megawatts. So there's a long way to go. In fact, until 2030, the capacity is expected to grow more than 8 times to about 13 gigawatts. That's a big bet. Hopefully, the company can deliver at least a part of that. Now, the concentrated production that the company's been doing by reducing the number of places that it's producing has enabled less heavy investment. What I'm showing in this particular chart is that the CAPEX of the company has gone down considerably over time. Equinor was able to reduce CAPEX over time as it's concentrated its oil and gas production. Right in 2021, it produced 15 in 15 countries compared to 30 in 2017. That allows them to basically invest less. The number might fall further as the company reduces exploration efforts to 10 out of 15 where it is currently producing right now. So let's look at another chart that I've gotten, and that's showing the growth in CAPEX. CAPEX picking up substantially and growing at about 9% per year over the next 3 or 4 years. In 2021, renewable CAPEX made up 12% of Equinor's total CAPEX compared to 4% in 2020. So it is significant. Now, with a $23 billion allocation to realize its renewable energy growth plan, CAPEX should rise much faster. Getting the CAPEX forecast right is crucial for determining the value of a company in a capital-intensive industry. If we get that wrong, we may over or underestimate the free cash flow. Now, what's the third story? Well, strong years ahead has led to attractive dividend yields. I show a chart where I have the dividends and the buybacks stacked on top of each other, and we can see that basically in 2019, dividends and buybacks were at combined amount of $4 billion US. Then they went down in 2020, crisis. Then they went down in 2021 also, and then we expect that they're going to start to rise over time, both the dividends and the share buybacks. Why? Because they're making a ton of money. In 2019, Equinor introduced its share buyback program. With the enhanced outlook, the management aims to increase the program to an annual $1.2 billion in buybacks, which can enhance returns. I also expect a strong increase in dividends over the next 3 years. The dividend yield could grow to a remarkable 4% in 2023. Now, scan the QR code if you're watching the video to go to valuationmasterclass.com. If you're listening to this on the podcast, go to valuationmasterclass.com or follow the link below, and you can download all the full case studies for free. So, let's look at the FVMR Scorecard, which measures a stock's attractiveness relative to all other companies. Attractiveness is based upon 4 elements: fundamentals, valuation, momentum, and risk. The scale is from 1 best to 10 worst. So let's look at the company here. I'm comparing against 90 non-financial companies in Norway only. I'm looking at the Norway market. And what we can see is if we look at momentum, we can see that there's good momentum in the past 12 months in revenue growth and good momentum in operating profit margin change. The momentum has been negative for recurring EPS growth, but hopefully that can pick up. Now, recently I created a short online course explaining my FVMR approach. I usually sell it for $97, but for a limited time I'm offering it for free. Just scan the QR code or go to the link below and you can get access to it. Now, let's talk about the forecast. Analysts are skeptical about how long the heightened profits can last. In fact, there's 30 analysts covering the company, and the downside they're expecting is 4%. In other words, the share price has gone up a lot, revenue has gone up a lot, they're getting scared. Most analysts are at a hold recommendation for now. There's 4 analysts have even issued a strong sell, which in the world of finance, many rarely do. Consensus expects 2 strong years in terms of revenue, but then a drop in 2023 due to normalization of commodity prices. Commodities are difficult to invest in. The cycles can be brutal. Equinor is engaged in a highly volatile industry. Let's run through the financial statements and ratios a little bit. First, let's look at the profit and loss. The elevated profit level of the next 2 years is solely driven by higher oil and gas prices. And basically, they had a loss in 2020, and then I expect that in 2021, they're going to have about a $9 billion net profit. Equinor did not aggressively expand its production. It was all driven by price. Let's look at the asset side of the balance sheet, and we can see that net fixed assets continue to decline as the company further narrows its production to just a few locations. It's part of its strategy to concentrate in highly profitable areas. Still, I expect net fixed assets to start rising in 2023 and onward due to the renewable energy expansion. So yes, there's CAPEX going on, and most of it is attributable to the renewables, and I think that'll pick up over time. Let's look at the liabilities of this company and see that the company has slightly increased its long-term debt over the pandemic period. However, I expect that part of its elevated profits can be used to repay the debt over time, so I'm not so worried about the leverage. If we look at some ratios, one ratio I think is interesting is the net profit margin. After making a loss in 2020, the company is likely to see a record net profit margin in 2021. That's about 10%. Still, don't expect the company to be able to maintain that margin over a long run because it is a cyclical company. Oil and gas prices can change directions very, very easily. Let's look at another ratio, and that is the cash conversion cycle. It's very low at about, let's say, 4 days in 2020 and 3 days in 2021 and 9 days in 2022 is what I'm expecting. But basically, this type of company has a trading aspect also to it that basically means ultimately this company has a very low level of inventory. Keep in mind that most of the production type of companies that are in the oil and gas space are a process flow, and the product is flowing through their system and going to their customer. So it's not easy to build up a huge amount of inventory. You've got tank farms and things like that, but it's not that common. Now, let's go into the valuation. And to do that, I want to look at the A-Stocks Investment Research Stock Picking Checklist. It was inspired by Peter Lynch's book about 10 baggers. And he wrote about that in his book, One Up on Wall Street. And that's a stock that has gone up 10 times. Now, this scorecard is based on our extensive research where we went back and looked at companies that did go up over 10 times and looked at their financial statements before they did. 9 factors drive long-term share price performance from my perspective. The first one is management. Management has a proven commitment to growth. And the potential here, I would say, is weak. The focus for management has been on production concentration and consolidation rather than aggressive expansion. The second one is growth. The product in the industry can support a decade of 10% annual growth. The average annual growth of the large listed companies in the world is about 6% for revenue. So if we can get to 10% consistently over the next 5 to 10 years, then you know that this industry and this company has potential. I would say it's moderate in this case. It's a highly volatile industry with rising demand. The company is subject to rapidly changing oil and gas prices, but generally demand is probably strong. It's just a matter of how much share prices will go up and down. how much the price of oil and gas will go up and down, that will determine the revenue. Now, the third one is sustainable. Competitive strategy creates sustainable high gross profit margin. Here, the company ranks pretty good. Being among the large energy players in the market, it helps them to maintain a stable gross margin. What about quality? Quality of earnings. Good earnings quality. Non-core items are small or non-existent. That's what we're looking for. Weak. High exposure to gains and losses from hedging oil and gas prices means you can get some funny numbers in the earnings. Number 5 is efficiency. In the long run, sales grow faster than assets. This is weak also. It's a quantity-driven increase in revenue, and it therefore requires heavy capital investment before you start to see the revenue come. It can take 5 years to build a new facility in the energy space. Tight. Number 6. Relatively low cash conversion cycle, negative is best. Here, the company ranks very good. We can see that the cash conversion cycle stood at 4 days in 2020 and should be fine. Number 7 is cash flow, that the operating cash flow is consistently positive. Here I would say it's weak. It's fluctuating operating cash flows. We're sometimes not even able to cover the amount of investing that the company wanted to do in the past. Number 8 is capacity. The company has access to capital to fund its growth. And here I would say good. It's state-owned. It's probably going to get funding. Number 9, and the last one, is that it's inexpensive. We're looking for valuation that's reasonable, and we want to try to avoid very expensive stocks. Here, it's moderate. It's cheap on a 2021 PE, but in line with price to book compared to Norwegian energy companies. So just a moderate chance. If you add all that up, I'd say that this is probably not going to be a 10-bagger, but there is opportunity in the share price. Now, the opportunity is going to come if we can get the volume. So let's now look at the free cash flow to the firm. And here, I just want to highlight that the CAPEX is going to be significant. Equinor faces higher CAPEX over the next few years, in line with its plans to slightly increase oil and gas production and to realize its renewable energy target. Let's get down to the assumptions. My assumptions for revenue is about 23% CAGR growth over the next 3 years, and a gross margin of about 43%, net margin about 10%. I'd say those are pretty good assumptions, given that we've already had a pretty strong rise for the company. So the ongoing energy crisis in Europe should support a higher price level than usual. I expect the company to record revenues over the next 3 years, and then after that probably come down. However, after that I expect some decline. If we value this company on a free cash flow to the firm basis, I just want to talk about the cost of equity. I estimated about 12.3%, the weighted average cost of capital about 8.4%, terminal growth rate of 2%. So let's get down to the value estimate. The base case is $25. That's a downside of 11%. The bull case is $28, which is basically where the stock price is today. And the bear case is a downside of about $25. So I don't find the stock that compelling right now. Let's look at the company's world-class benchmarking scorecard, where we identify a company's competitive position relative to global peers. We use a composite rank of profitability and growth called profitable growth. The scale is from 1, which is the best, to 10, which is the worst. Here you can see that the company has really not done well. I'm comparing it against 310 large energy companies worldwide. In 2017, it was ranked number 1 amongst all of these 310 large energy companies worldwide. Then it fell to a 3, then it fell to a 5, and recently it's fallen to a 6. That's below average. 5 is about average. Now, what's causing that? Well, profitability is ranked at a 6. That's the return on assets of the company. Not particularly impressive, and the poor growth basically has been a 7, a 6, and an 8. Very much under the average, below average performance on earnings growth. So not impressive on the world-class benchmarking scorecard. Finally, what's the risk? Well, the key risk is a slowing economy. Potential economic slowdown could lead to a rapid decline in energy prices, and unexpected weather could cause some damage to oil and gas plants. And then there's failure to realize the fast shift to the green energy. So let's wrap it up. The conclusions. The revenue explosion is solely energy price driven, while production is relatively stable. Falling energy prices could lead to negative market sentiment, and attractive dividend yield and repurchases might not be enough to compensate for a potential fall in price. So, to wrap it up, How much can Equinor exploit Europe's energy crisis? What do you think?